What if I tell you that the price of a burger could explain why the Indian rupee falls and rises against the dollar? It sounds crazy, I know. But before I tell you all about Burgernomics, I want you to know that this is an oversimplified breakdown of currency movements. It won't make it into your economics textbooks. And with that out of the way, let's approach this video in this manner. So, we'll start with a primer on currency theory and why things go up or down. Then we'll get into purchasing power parity, which has everything to do with burgers. And finally, we'll discuss something called the real effective exchange rate. And if that sounds interesting to you, stick around. So at a basic level, the relationship between two currencies is all about supply and demand. Let's take the Indian rupee and the US dollar as an example. If Indians want dollars to pay for computers and phones they buy from abroad, they'll exchange their rupees for dollars. So there's a supply of rupees and a demand for the dollar. And if this happens on a large scale in the global markets, with more people demanding dollars for their purchasing needs, the dollar will rise against the rupee. And it works in reverse too. If more people want the rupee, say because they all want to invest in India's stock markets and startups, the rupee will get stronger. Now, of course, there's a little more to currency movements than just this. But at its core, it's this supply-demand equation that's at play. Now think about what typically happens in India. As a country, we have a trade imbalance, or you can call it a trade deficit if you want to. We import more goods than we export, which means we end up needing dollars to pay for those imports. That involves converting rupees to dollars. It increases the demand for dollars and it weakens the rupee. Now sure, we get inflows into our stock markets, the bond markets, into our startups and other companies. But if this doesn't counterbalance that trade deficit, the demand for dollars will almost always outpace the demand for rupees. And the rupee falls against the dollar as a result. Now look at this chart of the rupee-dollar dynamic over the past 15 years and you'll see how this plays out. From 50 rupees to a dollar to 90 rupees to a dollar, it has been quite a fall. But is a falling currency, or a rupee in this case, a bad thing? Psychologically, we like to boast about a strong currency. It makes us feel good. But it's not always black and white when viewed through an economic lens. There's the good and there's also the bad. Let's start with the bad. If you have been dreaming about that international holiday to New York, that's getting more expensive by the day as the rupee falls. A $5 coffee that earlier would have cost you 400 rupees might now set you back by 450 rupees. And the same goes for any foreign master's degree you were hoping to graduate with. Your rupee will get you fewer dollars and things might seem out of reach. Also, if there are companies in India which borrowed money from foreign lenders, they are going to see higher repayments in rupee terms too. They'll be hurt. And on a countrywide level, the buyers have to shell out more rupees to import all the things we consume. The oil, the gold, the electronics, everything. And that higher price, it gets passed on to you and me, which means higher inflation. But there's the good part too. For foreign buyers, Indian goods and services become cheaper. Their dollar will fetch them more stuff in the Indian market. Earlier, if they'd pay $1 and get 85 rupees worth of stuff, now they'll get 90 rupees worth of it. And that is a pretty big benefit for India's exporters, the IT companies, the pharma companies, the textile sector. Foreigners might buy more just because it works out cheaper. Foreign investors might also invest in Indian businesses and get more bang for their buck. The foreign direct investment numbers could also improve. Even non-resident Indians, the NRIs, they might flock to the banks to send more money back home. And this is quite a decent chunk of money because we get nearly $150 billion in NRI remittances on a yearly basis now. So, a falling rupee could mean more money in the hands of a certain section of Indian households. And it is money that could get spent into the economy. So there are two sides to a falling currency. Anyway, now that we've got those basics out of the way, there is one question we need to address. How can we tell if a currency is overvalued and it is due to fall, or whether it is undervalued and could rise? One way to understand the valuation is through Burgernomics. Now, this is not an actual economic theory, but it has sort of become a semi-official standard now for currencies. See, in 1986, the Economist published something called the Big Mac Index. And if you didn't know, the Big Mac is probably the most famous burger in the world. It's a burger created by McDonald's, and a fairly standardized version of it is found in stores in every city across countries, wherever McDonald's operates, of course. In India, the equivalent of that is the Maharaja Mac. And by using the very relatable Big Mac, the Economist took a boring economic concept and turned it into a fun lesson on currency exchange. A lesson on purchasing power parity or PPP. PPP tries to answer the question, should a burger or anything else cost the same amount of money everywhere if you convert the price to a common currency? And this helps us to compare the real exchange rate, or let's call it RER. I'll explain this. Say a burger is $2 in the US and the same one is 160 rupees in India. If the ongoing exchange rate is 80 rupees to a dollar, it's perfect. The same amount of currency is buying you the same thing in different countries. There is equilibrium. Or put into an equation, RER equals E into P1 by P2, where E is the nominal dollar to rupee exchange rate, P1 is the price of the product in the US, and P2 is the price in India. That is equilibrium. But if the actual exchange rate is 90 rupees to a dollar, then the equation gives you this. And now you could argue that the dollar is overvalued according to PPP, that it should fall, or that the rupee should strengthen to 80 rupees a dollar to ensure that there is equilibrium between the currencies. This is the core takeaway. And in theory, PPP tells us that the exchange rates should move towards a rate that would make the price in dollars of a Big Mac the same in various countries. But wait, does the Big Mac index actually work? Can it predict the future movement in the exchange rates? Yes and no. At least that's what the Economist says, and I'm going to quote them. The Big Mac index does not have such a perfect crystal ball. Its predictive power in the short term is especially weak, but it has a decent record over a 5-year horizon. What they're saying is that it's not perfect, and it's also only looking at one product, the Big Mac. It's not really a representation of economies, and it doesn't usually factor in labor-related differences too, which is a big factor in the final price of a Big Mac. Also, the very idea of PPP, it ignores real-world costs like shipping, tariffs and taxes, amongst other things like the circulation of money in the economy, which actually has an impact on currency movements. So all of this, it hurts the predictive power of the Big Mac index. But the theory behind PPP does set the base for us to sort of expand upon it now. And instead of only comparing one currency pair, the Indian rupee to the US dollar, and only one product, the burger, what if we could account for more? And that is what the real effective exchange rate does. The REER takes into account a country's entire network of major trade partners and traded goods. It applies a weight based on how much trade is conducted with whom, adjusts it for inflation or the price differential, and then comes up with an index value. A value above 100 denotes that the currency is overvalued, while a value below 100 is undervalued. Simple. So this is what economists and analysts like to use when they want to make a call on whether a currency is overvalued or not. And here's the thing. Because the REER is an average, it may be in equilibrium even when a country's currency is overvalued relative to one other trading partner, so long as it is undervalued relative to others. So India could be undervalued against the dollar, but if it's overvalued against, say, the Russian ruble, it sort of evens things out. Oh, and one more thing you should know is that the index measures price exchange levels relative to a base year. If, say, the index is 100 in the year 2015 and 120 in 2025, average prices are 20% higher than in 2015. India calculates its own REER with 5 currencies and even with 40 currencies. But for this example, let's look at this chart from the Bank of International Settlements, because it's quite a comprehensive measure taking over 60 economies into account and with a base year set to 2020. At the beginning of 2025, you'll see that the Indian rupee was actually overvalued against this set of trade partners. At nearly 105, it was actually the most overvalued it had been for quite a while. And now if you think back to what I said earlier, the pros and cons of a falling currency, you'll realize that an overvalued rupee could be problematic for India. For foreign buyers, Indian goods and services suddenly look more expensive. And with the Trump tariffs coming into effect, it'll cost them even more. So they might not buy from India as much, and they might even shy away from investing into Indian companies. And the FDI numbers too could drop. But by the end of the year, the rupee fell and the REER showed the value to be 95, which means it moved to undervalued territory. Now, of course, this doesn't mean that the rupee will strengthen again. There's a lot of factors at play. There's the demand versus supply, if foreign investors find our country attractive enough, and even if the RBI decides to intervene. But the REER is an interesting way to see where the rupee or any other currency stands in terms of its valuation. Now, before you go, there's one more thing I need to admit. I know that I said that a burger, or the Big Mac index rather, it would have been an indicator of whether the rupee was overvalued or not. But looking at this in 2025 wouldn't have helped you. See, at the start of the year, the rupee was 85 to the dollar. A Big Mac in the US was roughly $5.7 and a Maharaja Mac in India was around 270 rupees. That means the RER should have been 1.794, which essentially means that the rupee should have been trading at 47 to the dollar to achieve equilibrium. Simply put, the Big Mac index would have told you that the rupee was undervalued and needs to strengthen. So, the next time you want to know if the rupee is overvalued or not, maybe skip the Big Mac index and look at the REER instead. You will have a better picture. And if you have any thoughts on this video, do drop in your comments and we'd love to answer them.